Good morning, everyone. Welcome to Phillip Securities Research Morning Call. For today, we have stock counter updates from First Sheet Lease Trust and First Sponsor Group Limited, Mapletree Industrial Trust, Frasers Centrepoint Trust, CICT, DBS Micromechanics, Venture Corp, and also Sheng Siong Group. And we will be wrapping up with the usual Singapore Weekly. So first of all, let me start with First Sheet Lease Trust first quarter FY 2021 results update, which is mainly relying on the dividend support. So referring to the first positive point, first Q DPU grew to 2 US cents per share if you refer to the last line on the table on your left. And the trust has managed to distribute higher dividends with proceeds from the sale of their tankers. Referring to the second point, they have a strong liquidity position supported by healthy cash flows. So the trust has managed to clear all their borrowings in March this year, and for this quarter, net cash was at $47.8 million US. On the operating cash flow side for first Q21, it was a positive $3.5 million US, referring to the second last line on the table, and this compares to 16.6 million a year ago. So moving on to the negatives, the trust recorded lower revenue and net profit, declining by 64.3% and 95% respectively year on year due to a weak tanker market and also a smaller fleet. So comparing to when they had 15 vessels in first Q20, they now have 11 tankers. The contracted revenue also fell slightly from 29.8 to 26 million US dollars. So the outlook for the trust remains subdued as tanker rates are expected to remain at low levels, with most international borders remaining closed and air transport recovery limited. So if we were to talk about the crude oil tanker freight rates, which is the main cause of their low revenue, it is dependent on the demand and supply of oil. So although according to the OECD, Organization for Economic and Cooperation Development, the oil demand is forecasted to grow in 2021, but it will still be below pre-pandemic levels in 2019. And more of the recovery is expected for the later part of second half of 2021. Meanwhile, floating crude oil storage has decreased over 2020, adding more tonnage back to the fleet. So what this means is basically floating storage is tankers that are left idled offshore for at least 7 days. So when crude oil prices plunged to historical lows last year, some traders purchased oil and stored them on the floating vessels, but they have since been unloaded. So the volume of the floating storage has decreased dramatically over second half of 2020. And as such, there is an increased supply of tankers. So they are unloaded to oil refineries and also onshore storage. And with low demand and high supply, the outlook for tanker freight rates continues to be bleak in the short and medium term. So we maintain accumulate with a lower TP of 3 cents. And this TP is based on 0.9 times FY21E price to book ratio. And we have FY21E net profit due to a subdued tanker market. And also for the DPU, we raised it by 56.7% to 6.33 SG cents. So this is the main reason for the accumulate call, even though the target price is much lower than the stock price. So the stock is supported by the dividends. And we expect FSL Trust to pay out all of their FY21E operating cash flow of $14.5 million US, together with net sales proceeds from their recent disposal of 3 product tankers of $55 million US. And also, we are expecting potentially more disposal of tankers which are loss-making or due to old age. So that's all for FSL Trust. I'll now be passing the time on to Jie-Hui for First Sponsor Group.
Thanks, Vivian. Next, we have First Sponsor's first quarter operational updates. So before I start, you may find the list of property development projects that First Sponsor embarked on at the bottom right table. What's launched and largely sold right now are the first 4 projects under the Dongguan list, as well as Plot E of Millennium Waterfront. The remaining projects are newer and awaiting launch for pre-sales. So just starting with the positives, we estimate 180 million of gross development value, GDV for short, to be recognized in first quarter. This is attributable to the handover of sales at two of First Sponsor's older projects, Star of the East River and Emerald of the Orient, as well as some units at Millennium Waterfront. Referring to the table on the top right, for the coming 2 quarters, we are looking at another 50 million from the Dongguan project and 65 million to be recorded from the Chengdu project. This equates to a minimum of 115 million worth of gross development value waiting to be recognized. In late 2021, we will also start to see the handover of the Pinnacle. So in total, we are looking at more than 300 million worth of gross development value to be recognized this year to prop up First Sponsor's top line as well as their share of associate segment. In terms of the negatives, the hotels in Europe underperformed as demand for both regional and city hotels was affected by COVID-19. Most of First Sponsor's own hotels were operating at EBITDA losses despite subsidies from the government. For its Dutch buildable portfolio, the portfolio occupancy fell by close to 80% year-on-year. Revenue per average room, RevPAR for short, fell by 83% year-on-year. As such, FSMC Group, which is 33% owned by First Sponsor, deferred its 4.2 million euro interest payment in first quarter on loans extended by the group. That said, First Sponsor does not expect any recovery issues for the deferred interest and loan principal. Next, please. Okay, we hosted a reverse roadshow for First Sponsor, so just providing a snapshot of what was discussed. Dongguan's market is still hot for property development. Despite price ceilings based on Dongguan's residential properties, prices are still rising and the residential inventory within the municipal is low. Within the central regions of Dongguan, units are snapped up within 2 months of launch. And even though some units have a stipulated holding period of 5 years or so before they can be sold, buyers are actually paying upfront to reserve the units. Dongguan's projects contribute about 50% to First Sponsor's total GDV to be recognized. Property financing is also less risky than most may think. First Sponsor only lends on real estate that is willing to own. And before 2020, it has just 2 default cases, which in both cases is succeeded in recuperating both principal and penalty interest after collateral auctions. Loans are typically secured on LTVs of 50% or lower, and penalty interest is much higher than that of initial interest. In 2020, First Sponsor commenced legal action against the borrower group with 2 cross-collateralized loans due to arrears for a month's interest for 8 months. First Sponsor already privately settled with the group on 16 March 2021, which has paid its first monthly installment and prepaid its second monthly installment in April 2021. This year, we are expecting a record pre-tax profit to be bolstered by property development as well as property financing. After profits recognized this quarter, property development gross development value to be recognized stands at 620 million. As mentioned, we are looking at more than 300 million worth of gross development value to be recognized this year. Additionally, First Sponsor's PRC loan book is also expected to grow by 30% with the new Human project that First Sponsor took on just last week. First Sponsor will extend loans of 84 million and 90 million Sing by way of convertible bonds with interest rates of 15% and 12%. Greater property financing revenue is expected to come through post-May when the convertible bonds are released. Our target price remains unchanged with a sum of the parts target price of $1.56, but we downgraded our call from a buy to an accumulate, given that there's lesser upside to our target price due to the recent recent write-up in stock price. So this is all for First Sponsor. Next, we have Mapletree Industrial Trust, Phillip on the ground. We do not have any coverage on this counter. In terms of their 4Q results, 4Q and full year results, 4Q distributable income increased 2.3% year-on-year, while DPU was up by almost 16%. This is due to the release of the tax-exempt income, which was previously withheld in 4Q last year, which is why year-on-year there seemed to be a drastic improvement. However, assuming that MLT did not withhold any tax-exempt income last year-on-year there's actually not much change. On 12 March, MLT completed the acquisition of a data center in Virginia. We should see the full year recognition in this coming fiscal year. In terms of valuation, total valuation increased by 14.3%, largely due to the acquisition of the remaining 60% interest in the 14 data centers in North America, as well as the Virginia data center. Singapore's portfolio fell marginally by 1.3%. Post the Virginia acquisition, which was funded by debt, their gearing levels are now at 40.3%. But at this level, the REIT is still not very concerned. It doesn't prevent them from taking on other opportunities. Lease expiries for the next 2 years are well spread, and tenant retention levels remain high at 85%. In terms of market outlook, there is a slight recovery in portfolio occupancy, but the REIT is still seeing negative rental revergence across most property segments. As industrial occupancy still face rent pressures, or still face pressures from downsizing or consolidation of space, Min will still continue to focus on tenant retention within the properties and focus more on filling spaces over potential positive rent revergence. So just to give you an example, Min had some companies in the infocom sector which are supporting the financial institutions that reduce their space needs. And this is actually more evident in their business parks. Also, it's likely that we will see increasing construction costs to increase capex spend on redevelopments. For Min's redevelopment of Kolam Air 2, this is the project to actually convert 2 of their affected factories and an amenity center into high-tech buildings. Min saw an increase in redevelopment costs from 260 million guided previously to 300 million due to social distancing measures, labor constraints, and more PPE required for construction. As such, their yield on cost expected for the redevelopment is expected to decline from 8% to 7%. In late 2020, Min commenced construction for 2 buildings. Construction contract for the 3rd building has yet to be awarded. However, as Min has structured the contract to include the development cost for the 3rd building as an option, 300 million is expected to be the all-in cost for the entire redevelopment. Yeah, this is all for Mapletree Industrial Trust. I'll pass my time on to Ned for Frasers Centrepoint Trust.
Thank you, Jia Hui, and good morning, everyone. So starting off with Frasers Centrepoint's first half 2021 results. Okay. So for just starting off with the results at a glance, we see that revenue has actually increased by 73.8% year-on-year. This was due to the 5 months contribution from the ARF asset acquisition. And this is partially offset by absence of atrium rental revenue and the divestment of Bedok Point. So flowing right through to the DPU line, we see that DPU has increased by 28.4%, and this DPU of 6 cents is actually in line with our estimate. Is up with our estimates, forming 28.4% of our forecast. So moving on to the positives. We have 2 positives. The first one is tenant sales grew in January and February, and that outpaced the retail sales index. So the tenant sales grew by 0.4% and 11.7% in January and February, and that outpaced the RSI's negative 8.1 and 7.7%. So of course, we know that February was a better month due to the Chinese New Year sales. So FCT's sales grew even faster than that of the general market. So this improvement in sales was in spite of an absence of atrium sales, which are still prohibited due to safe distancing. So of course, that said, that recovery among trade sectors remains uneven. Another positive is the divestment of UT Point at 15.8% above book, and this mall will be the 3rd mall that FCT has divested over the last 6 months. So it is part of FCT's strategy to pivot towards larger malls with bigger catchments, as they believe that larger malls, the selection of variety will actually attract tenants as well as shoppers. Okay, so they will use the proceeds to pare down debt as well as lower gearing. And for the negatives, okay, retail sales, retail occupancy actually dipped 0.3 percentage points from 96.4% to 96.1%. So this is this 96.1% is about where the occupancy was just 1 year ago. Some malls have already recovered to pre-COVID occupancy levels, such as Causeway Point. Occupancy increased to 1.5 percentage points to 99.6%. And there was some improvement in several other malls, such as Changi City Point, 4% improvement to 95%, and also Hougang Mall, which is now 99.3% occupancy. So these positive occupancy gains were wiped out by two sort of non-renewal and termination. So one of them was actually at Waterway Point, where we saw an anchor tenant, H&M, pre-terminate and exit the mall. So that actually resulted in a 5.9% decline in occupancy. So occupancy for Waterway Point is now 92.2%. Similarly, at Tampines 1, the mall saw the exit of Uniqlo, one of their mini anchor tenants, and that sort of reduced occupancy by almost 5%. Yeah. Okay. So if you look at FCT's only office tenant, office asset, which is Central Plaza, occupancy also fell over there from 95.3% to 92.1% quarter on quarter. Another negative is that 1H rental reversions were negative. Negative 0.7% for the retail portfolio, and for the portfolio as a whole, the reversions were negative 1.5%. So this was based on a new computation, which is basically they're using the expiring rents divided by the signing the signing rents divided by the expiring rents, and then the average of all of these computations. However, if you look at the old methodology, which was the average of the total rent signed right now versus average of the expiring rents, then that would have resulted in a positive rental reversion. So this overall, the negative reversions, the largest negative reversion was actually booked by Changi City Point. That was a negative 10.5%. And of course, Changi City Point is where we see a little bit of is more challenged because it's surrounded by the Expo as well as some of the business parks in the area. And as we know, work from home, the workforce is gradually returning to the office. So lunchtime crowds are down, and there's virtually no booking for expo sales or conventions, etc. So the demand for space at Changi City Point, which actually benefits from all of these footfall, is a bit challenged. Okay, so in general, most of the rental reversions were within the negative 1.2 to positive 1.9 range. Okay, in terms of outlook, there will be a low single-digit impact from the Code of Conduct if applied to all leases concurrently. So the Code of Conduct will actually apply for leases signed on the 1st of June onwards. So because the Code of Conduct is only for leases that are signed from 1st of June onwards, and it does not apply retrospectively, the impact from this implementation of the Code of Conduct will actually be more gradual. So this low single-digit impact is if it was all to be recognized and applied at one point of time. Yeah. Okay. FCT also continues to rationalize their costs to reduce duplication as well as manpower. So over the years, they have, with the help of technology, they have actually reduced the reliance on manpower as well as digitize some of their processes. One example is the increasing of CCTVs as well as the quality of the CCTVs to reduce the number of security personnel required, and also consolidating the fire command across the malls to reduce duplication and manpower costs. So they intend to do the same for the mall cleaning services and optimize the mall performance through economies of scale. And the management commented that while immediate savings are not substantial, this initiative could help keep costs in check, especially as wages climb. So in terms of acquisitions, FCT will remain Singapore-centric. They can inorganic growth opportunities come from, of course, the sponsors pipeline, as well as increasing their stake in Waterway Point. They can also look to partner or acquire single mall assets from owners. Such as, there are some construction companies that only own one mall. As such, it makes it difficult for these kind of single mall owners to, implement any loyalty programs or omni-channel infrastructure to help their tenants. So this presents an opportunity for FCT to, even acquire the mall or perhaps work in a partnership arrangement with these single-owned malls. Okay. So the last part of this for Frasers Centrepoint Trust is we maintain our buy. We lower our target price slightly from $2.93 to $2.88. Next. Yeah, okay, so we lower our target price slightly, $2.93 to $2.88. Our DPU dips by 1.2% and 1.4% for FY21 and 22 after accounting for the divestment of UT Point, which will be completed in May of 2021. So FCT at this current price is trading at an attractive 5.5% FY21 DPU yield. So that's all for Frasers Centrepoint Trust, and moving on to CapitaLand Integrated Commercial Trust. So for the positives, this is operational update. There are very limited financials released, only the revenue and the MPI. Okay, so starting off with the positives, retail MPI fell by 7% in the first quarter year-on-year. In the first quarter compared to 1Q20 levels. This is an improvement compared to 4Q20's MPI, which was about 16.7% lower year-on-year. So for the office and integrated development, MPI was -7% and -15% of lower than first quarter 20's MPI. For downtown malls, we noticed that they are actually catching up with their suburban peers. So, and the tenant sales, actually showed growth this quarter. For the downtown malls, the first quarter tenant sales improved to -1.2% year-on-year. This compares to where they were in the fourth quarter of 2020, which was -6.3% down year-on-year. For the suburban malls, they continue to show stronger growth. Tenant sales grew by 4.3% year-on-year versus in fourth quarter where we saw tenant sales grow by 1.3% year-on-year. Overall, 10 out of 15 trade categories booked growth. Okay, average cost of debt also fell quarter-on-quarter from 2.8% to 2.4%. So if you compare to where they were in the third quarter of 2020, the average cost of debt was 3.1%. So now we are at 2.4%. That actually is a quite significant interest expense savings. So this was due to the refinancing of loans using two long-dated fixed rate issuance this quarter. On to the negatives. So portfolio occupancy dipped quarter-on-quarter from 96.4% to 95.9%, and this was due to largely due to the retail portfolio, which experienced a 0.9% dip from 98 to 97.1%. So a large contributor of this decline in occupancy was from Raffles City's retail tenants. So occupancy fell by 5.6% to 90.9% after the exit of Robinsons. So the space vacated. Robinsons actually occupies 3 floors. So the space in level 3 is still currently vacant. Another contributor to the decline in occupancy was Clarke Quay. So Clarke Quay's occupancy fell by 5.4% as the nightlife and entertainment leasing still is challenged due to the COVID-19 situation. So CICT will be conducting feasibility studies to reposition these two assets. Okay. So there were also some negative rental reversions. So there was no official figures for rental reversions that were released, but we understand from the management that the retail rental reversions were negative, about -5%. Yeah. And for the downtown malls, it was more challenged, negative in the negative double-digit region, so negative teens basically. One other observation, of course, would be that the office tenants are still sitting on the fence. So leasing inquiries, especially for expansion and new space, have actually increased by 1.7 times in the first quarter as compared to 4Q 2020. So while there has been more demand and inquiries for expansion and new space, as well as relocation, the office tenants are still relatively undecided, and they require a longer time to actually come to a decision whether they would like to expand, downsize, or keep the same amount of space that they have already leased. Yeah, and of course, this is because some of them are still taking a longer time to finalize their stance on remote working, as well as the amount of collaborative space that they will require. Moving on to the outlook, CICT actually restructured the hotel lease for the hotel tenant, which is Accor at Raffles City. So what happened with this lease is that they decided to restructure this Accor lease to give the tenant some breathing room. This restructuring was done on the 1st of January, and the lease term has been extended by 5 years to 2041. There will be a rent review in 2027. And overall, what happened is that the fixed component of the rent has been lowered by about 15%, while the variable component has been raised. So the impact of this change in or restructuring of the lease terms is that if the hotel sector were to sort of improve back to 2019 levels, then CICT would be receiving higher rent than what it was collecting in 2019. Yeah. Okay. Another slight positive that came with this restructuring was that the lease with Accor, actually they have been put on the deferred installment plan, where they will have to progressively repay the amount that they were owed. They have owed CICT. They are currently ahead of the installment timeline, so they actually paid down the debt, and that is of course positive for CICT as it reduces CICT's exposure to this tenant. CICT is also revisiting some of its asset enhancement plans, specifically for Raffles City as well as for Clarke Quay. So for Raffles City, as mentioned, level 3 is vacant due to the exit of Robinsons, and they are trying to do feasibility studies to see how they can add vibrancy to the mall as well as complement the existing tenant mix. And for Clarke Quay, they are trying to do studies to reposition Clarke Quay to include tenants that can trade both in the day and night, as opposed to the current predominantly night trade kind of trading. Yeah, and they also will improve the layout and rebalance its trade mix to complement its neighboring Liang Court, which is currently still under redevelopment. Yeah. Okay. So we maintain our accumulate and raise our target price slightly from $2.50 to $2.54. Our DPU increases by 1.3% and 2% for FY21 and 22 respectively. And this is after accounting for a lower cost of debt assumption upon refinancing of the loans. Okay. So current price actually implies a 5.2% FY21 DPU yield. So that's all for me. I'll pass the time on to Terence for DBS.
Yep, thanks Natalie, and good morning everyone. In our next slide, we provide a summary of DBS first quarter results. DBS reported first quarter results that beat our estimates, with earnings at 34.5% of our financial year 21 estimates. The beat came from net fee income and a $190 million reversal in general provisions. You can see this on the allowances row on the table on the left-hand side. So you can see just after profit before allowance on this table on your left-hand side, you can see that the total provisions made for first quarter of 2021 was only $10 million, as compared to a year ago at $1.1 billion, or even the fourth quarter, where they made about $577 million. So really a big reduction in the total allowances. For first quarter, the NIM fell 37 basis points on a year-on-year basis to 1.49%. But this 1.49% is at the upper end of the management's guidance for their NIMs for FY21, which is between the range of 1.4 to 1.5. So you can see it's really the top end of the range. On a year-on-year basis, loan growth of 7% also cushioned the net interest income. You can see the net fees and commissions also surged 15% on a year-on-year basis, rising above pre-COVID levels. So for first quarter, they actually reported $953 million, which is a record. The The first quarter also saw credit costs stabilize, resulting in a general allowance write-back of $190 million, and the specific provisions have already returned to pre-pandemic levels of 21 basis points of the total loan, or $200 million. So total allowances guided by management for FY21 likely to be below $1 billion, and so they expect this amount as well. In our next slide, we sum up our key takeaways from DBS results. Net interest income grew 2% on a quarter-on-quarter day-adjusted basis. NIM at 1.49% was unchanged also on a quarter-on-quarter basis and remained at the upper end of its guidance. Net fee income increased 15% year-on-year, driven by wealth management fees and transaction services fees as well. The credit costs also stabilized, and full-year allowance likely to be less than $1 billion. In one of the negatives, though, for us for these results is there's still no indication from MAS also on when they will lift the dividend cap. To recap, the dividend cap was implemented in 2020 for the banks to pay out only 60% of their dividends so that they can preserve capital. But with all their allowance and reserves ratios all above the regulatory limit, the DBS has already indicated that once MAS leave the dividend cap, they will move the dividends back to the pre-pandemic levels, which is the 33 cents a quarter, translating to about $1.72 on an annualized basis. In our last slide, we sum up our outlook for DBS. Business momentum remains strong. Singapore's latest economic data confirm a strengthening of the global economic recovery. We therefore upgrade our fee income estimates for FY21 and FY22 respectively. We also lower the allowance estimates for FY21. Consequently, our earnings for FY21 and FY22 are raised by 5.6% and 1% respectively. In terms of inorganic growth, their acquisition of Centrepoint Rural Commercial Bank and Lakshmi Vilas Bank is also well on track. Centrepoint Rural Commercial Bank is earnings and ROE accretive right from day one. This acquisition is of course pending the regulatory approval, but once approved, it will be earnings and ROE accretive for the group. Our recommendation is to accumulate with a higher target price of $31.40, up from $29.50 previously. This is because we raised our FY21 earnings by 5.6% as we lower allowances and crank up their fee income estimates, which we think can continue to grow by double digits percentage for the year. We now assume 1.36 times FY21 price to book in our Gordon Growth model valuation, up from 1.31 times previously, as we raise our ROE estimates modestly to 10.4% and increase the overall book value. So that's all from me. I'll now hand over to Paul, who will cover micromechanics, venture, Sheng Siong, and the Phillip Singapore Weekly. Over to you, Paul.
Yeah, thanks, Terence. I hope you can hear, because my StarHub fiber is down, so I'm using like 4G right now. Anyway, Micromechanics released their third quarter. The title a tad below expectations, just that the earnings was good, but it was just slightly below our forecast. In terms of the results, the third bullet point at the bottom, the numbers were slightly below our forecast. I think 77.64. I think revenue was slower than expected because do remember that the following March quarter last year there was a lot of disruption because of the China impact of the Chinese pandemic. In terms of the positives, go back to the top again. Revenue in certain geographies grew very strongly, like 33% in Singapore and China. There was some weakness in Taiwan and surprisingly even in the US. So what we think is happening is that some countries which have a larger automobile exposure is suffering from the disruption in chip supply. That's why some countries are performing well and some are less so. I mean, that was one of the reasons given. In terms of the negatives, you can see that they still hit record revenues and the increased product complexity. But in the previous cycle in 2017 and 2018, when they were running at these kinds of revenue run rate, margins were as high as 57%. But right now, as you can see, the margin is only 54%. Part of the reason is the utilization of only 60% in the previous cycle, but right now it's 56%. So I think because of the ramp in capex in the past, they have not been able to to fully utilize the capacity, and that's why there's a bit of slack in terms of the margins. But I mean, the results overall was still positive. I think if you look at the PATMI again, sorry to dial back again. If you look at PATMI 4.2, because there was government grants the prior quarter of 300,000. So if you add that back, you will probably get like a low teens kind of growth for them. So the numbers were just not too bad, but just that it was slightly below the run rate that we were expecting. In terms of the outlook, the semiconductor is still experiencing a multi-year upcycle. I think when we speak, you can speak to anyone in the supply chain, they can tell you that the lead times have all been stretched, some from 4 weeks to even to 1 year right now. Across components, the shortages are across the board. All kinds of components are on allocation or shortage or with longer lead times. So we still think that this will be a tailwind from micromechanics. And the other driver, like we mentioned before, is they are penetrating to the front end, closer into the wafer production equipment. Because right now they're doing more in back end. Just a bit of there's more complexity. I think the geometries of the wafers are shrinking, and also getting harder and harder in terms of handling all these wafer dies because of the advanced materials required. Sorry, it's a bit complex here, but anyway, I'll just move on to. We still maintain neutral. We lowered the target price, but do know that this stock is still giving you a 4% dividend yield, the last bullet point, and also backed by net cash. And again, the strength of this company or their product is a consumable. So some of their customers use their products for just a couple of hours and then they will discard it and then just use it again because it's a consumable. Because during the pick and place of the wafer dies, there's wear and tear in their consumables, and then customers like at one shift you will have to change and require a new batch of their products. So that's the strength of their model. Of course, regardless below my margin, but my target. But they're still earning high gross margins of 55 is my forecast, and also ROE of 32. Next slide. In terms of venture, so for the first quarter 21 update, there was another type of disruption. Do note that in this quarter, they only give 3 PowerPoint slides and that's it. So you just try to understand what is happening with these 3 PowerPoint slides, and there's no briefing. So in terms of the results, the numbers that was up, PATMI about up 2%, and the profit growth was about 8%. You can see from the table, it is running below my forecast. I think we are looking at 17%. And again, we had expected a stronger rebound, because last year there was a drop in their earnings about almost 20-30% because of the pandemic. So the recovery this time around isn't as strong as we thought. And one of the reasons they mentioned is that their fulfillment or execution is affected by a short supply of parts and components. Okay, and then we go back up to the top again. That's the positive. The big positive, of course, is always their cash. I think right now their net cash is almost $1 billion. And I guess one comfort we know is that they high chance they're going to raise their dividends again because the cash holdings is getting larger and larger. And of course, the operating environment is improving, so there's grounds for them to raise dividends. The other thing is that the PBT margin is still healthy at 11%. And then when we look at the previous times, again, we always look at the revenue and the margins. So in the 2015, 2016, when they had similar revenues, their PBT margin was only 8%. Right now, it's running at 11%. The negative is, of course, the revenue. It is very sluggish. It is only 2% growth. Like we mentioned, in first quarter 20, the revenue actually collapsed 30%. So obviously you should have a bigger rebound, but it's not happening. And like we mentioned, they said something about shortages and so forth. In terms of outlook, they guided for quarter-on-quarter improvement, stronger second half, first half year-on-year. These are obvious. I think everyone who probably kind of factored that in. But the other things they added was there's broad-based strength, and what will help, that's why we've not, even though the numbers were below expectations, we're not moving our numbers because we think that there will be more momentum in their healthcare products, like they mentioned, because it takes time to ramp. And also, they also highlighted there'll be new semiconductor and networking products in the pipeline. So I think all this can help make it a bit more back-end loaded in terms of the revenue growth. So we maintain our neutral recommendation and target price unchanged. Next slide. Move on to Sheng Siong first quarter 21 update. Basically, the title is that the revenue was resilient, but the problem is that there's just no new shops being rolled out, and this will affect the medium-term growth rate. Next slide. Okay, in terms of the results again, the first quarter and earnings was within our expectations. Earnings is 30%. Of course, it's higher than our, if you analyze it quarterly, 25%, but because this is a festive period. So if we go back to the positives, the key thing we watch for is actually to kind of strip out the impact of new stores. So what we look at is the revenue per square feet. So in the first quarter, the revenue per square feet was about 2,003, and this is still very strong because pre-pandemic the revenue per square feet was 1,009. So even though we've come out from a more extreme lockdown phase, the revenue is still elevated. So that's a positive. We didn't get at least a nosedive in revenue per square feet. And of course, gross margins were also still elevated at 27. Their records about 28, so they're still near their record levels of gross margins. If you look at the second bullet point, of course, it's their balance sheet again. They got like strong cash flow, and their net cash is probably another record of about 200 million, 40 million. Okay, the negative is just no new store openings. As you know, for Sheng Siong, the story is not just organic, which is usually quite slow, but the key thing is to get new stores. You can see from the table at the top, although their same store sales growth was 0%, what we saw was that the new stores contributed to 3 percentage points of all the growth. So new stores is very important for the investment thesis behind Sheng Siong. But this time round, they tendered for 2, they were not successful because of some aggressive bidding. And also HDB has kind of paused in terms of new stores. So this will affect medium-term growth. But they're bidding for one big store, which is like 14,000 square feet. So that could help. Hopefully they secure it, and then that could be rolled out quite fast. I think once they secure a store, within 1 month, they can actually roll it out. I think they got all the infrastructure, obviously. So they will roll out in the third quarter. So hopefully that can help in terms of the growth profile. 14% is maybe probably at 3-4 percentage points. You can see the average, the area, the 571,000 square feet they have right now. In terms of outlook, we still think that it will be elevated, the revenue, and one of the reasons they gave why supermarket sales is still strong, especially compared to pre-COVID, is that I think with the border closures, most people there are more households in the country, there's more dining at home and so forth. And also 2022 is maybe the place where we can see the new stores coming back and then the growth can resume. But for now, I think there's still no new store. So we maintain a cumulative with the unchanged target price. The thesis is still the same. I think, they got that impressive ROE 26. The yield is 3%, and they got the net cash to back the dividend yield. Next slide. Okay, I think we'll go back to our usual Singapore Weekly. In terms of the macro, we got some bank loans. Of course, the banking results are more important, but from the monthly data, we can see that the loans growth is accelerating. At least for total loans, it was at least shrinking less, I guess. It was flat, I think -0.2. But the year ago, it was down 1%. So we can see that loans growth is starting to pick up pace. And what is helping is housing loans. So housing loans grew 1.8% from the prior month of 1%. So the more important is the trajectory and the direction. And at least we can see that loans growth is picking up. So this will be helpful for the banks. In terms of some of the US news, I think we got the one important one for me, at least, was the inflation numbers. I think every month you just have to watch so that this thing doesn't run away. So inflation or core PCE doesn't run away. And then we have risk of the Fed raising rates prematurely. So the number was 1.8, close to their target 2%. But again, the Fed is very dovish or just saying that even though we get this number, it's just a one-time price increase. This is his quote, a one-time price increase because the economy reopened, and this is not likely to be persistent. So it's good that the Fed is in a way kind of ignoring any surge in inflation, so we don't have to worry that there's a premature interest rate hike. In terms of other macro, the numbers in the US are very strong. Auto sales is up 60%. The other news, I think, is just for information. I think there's going to be there's one more infrastructure. If you recall, there's a 2.3 trillion infrastructure package. I think that was really kind of highlighted few weeks ago. So last week, the there's now the 1.8 trillion American Families Plan. So obviously this is positive. What this one is more about, if you have a child, they give you more support, and then they'll give you free preschool, free community college, and then some paid leave incentive. I won't go to the details, but obviously this is all positive if it's rolled out, because it's going to be positive for the economy and so on. There was another data point that came out, which is Korean exports, and that was also very strong. I think Korean exports was surged 40%. So of course, obviously this is good for the electronics industry. In terms of tactical views, we are a bit cautious right now. I think with the elevated, with the rebound in cases, I think the recovery plays are at risk. That's why we see weakness in like SIA and so forth. And then there's elevated risk of maybe small limits being reimposed on social gathering, and we've already seen some of it. In terms of events, we've got Fortress tomorrow, and then like Penn United, if you want to ask about construction industry, you can just go dial in for that. And then APEC Realty, if you want to know more about property, you can just dial in for that. They're all in our Poems website. Next slide. Okay, in terms of the global cases, as usual, the focus is on the blue line, which is the global cases, and you can see it's at record levels. And the worrying thing is that it's rising 50% month on month. So don't expect any peak. We should not expect any peak in cases. It seems to be still rising very strongly. Next slide. I think very quickly, I think the sad one is the blue line. You can see in India, the number of cases continue to escalate. And even in Japan, you can see another wave, the red line, another wave is coming in Japan. I think we know the cases in Malaysia, Thailand, all rising back again. The good thing is, at least in the developed countries like Europe, you can see the cases are all dropping and collapsing. So that's the positive. Next slide. If you look at dial back into Singapore, we had 51 cases in a week, 10 in the prior week. So obviously the next thing we need to do is just to check how does this compare to when we had circuit breaker or phase 1, phase 2. So if you look at 6 April, this is the day before the circuit breaker, which is 7 April. You can see that, of course, circuit breaker, we had like 54 cases a day. Right now it's 51 over a week. But if you look at phase 1, phase 2, right now we are actually as high as any time during post-circuit breaker. So obviously there's a risk. I think hopefully not, but if this thing keeps on rising, especially the unlinked ones, then there's a risk that they'll dial back some of this phase 3, phase 2. But of course, nobody knows. But statistically, I mean, you look at the numbers, you can see for yourself that there is a risk. The worrying thing is that some of the infected have received vaccinations. So I mean, the worst case scenario, not just for us, but the whole global market, is that what if the vaccination doesn't work? I think that's going to be the ultimate worst case scenario. Well, hopefully that is not the scenario, but that is the biggest risk out there. Next slide. Okay, this is nothing much, but this is very important. You can see the blue line. This is just the inflation. The reason, just for info, is why we need to monitor this is that any surge in the blue line to maybe 3% or 2.5, then that could cause the Fed to raise interest rates faster than expected. Because the red line is their target, but they expect it to be above the red line. But I won't go through too much. This is a bit too economics. Next slide. Okay, we will just quickly run through Phillip on the ground. Again, this is not, we don't have coverage, but because we attended these briefings and we know a lot could not attend or could not get access maybe. So we just want to share with you some of the key things, and hopefully you can get some data points for yourselves. Again, we're not rated. So for Lipo Mall, they own like 22, almost 30 malls in Indonesia. So what is happening in Indonesian malls, I think for those who are interested, I mean, maybe some of you, and most of you may not be, but just for interest sake, I think what is happening is that they are giving out discounts as much as 33% last year to all their tenants. This year, the discount is 20% to all the tenants, and that is because of the operating hours. So last year, operating hours was only 8 hours, so the mall can only open for 8 hours. So that's why they have to give discounts. This year in 2021, it has increased to maybe 10 to 12, but they still have to give that discounts. And for the anchor tenants or entertainment tenants, the discount is 40 to 50%. I won't bore you with the rest. You can refer to for yourselves, but I think what is helping them is that they got this MPI guarantee because they acquired one big mall, and then the sponsor is giving some guarantee. And just one last bullet point, in Indonesia, only 5% of the tenants are on GTO. GTO means you can take a cut of the turnover, the gross turnover. But because over there the tenants don't disclose what sales they have for obvious reasons. So that's why they will not tell you what is the actual sales. Then we also attended Yang Zhejiang. For Yang Zhejiang, the numbers was very good. I mean, they doubled their earnings. But Yang Zhejiang, 60% of the gross profit is from interest income. So you can think of them like a bank plus shipyard. So it's a bit of a strange combination, but that's the reality. I think like half the profit is actually from lending money. And what happened is that they got this big jump in earnings year on year because there was a reversal of financial asset impairment. Basically, some of the loans they reversed, like a write back, they're almost like a bank. So they did some big write back. But in terms of the order book, they're doing very well, the shipbuilding. You can look at their order book right now is 6.6 billion. But whereas if you look at it a year ago in April, it was 3 billion. So the order book more than doubled, sorry. And then right now, if you want to order a vessel from them, you will only get delivery in 2024 because the yards are all full. I think the risk for them, at least the earnings wise, is that the steel prices don't lock in their steel price until a year or so later. So of course, if there's a big surge again in steel, then of course then it will hurt their margins. But again, just for your info. And just for your information, if you want to know, they got a 14.8 billion of loan book or debt investments, you want to call it. And then some of them are backed by shares, by land, government guarantees. The net cash is at a record level because all these orders came in, right? So they got a huge amount of cash. Because to order a ship, people have to put in deposits. So they got this record level of 8 billion of cash, RMB. Next slide. Okay, our usual, again, sorry, this taking very long, but I need 2 more slides. We have our usual absolute 10, our model portfolio performance. So we were up, the table on the left, we were up about 2%. What drove the portfolio was Propnex, and then some of our yield stocks, Asian Pay and also Manulife. Hurting us was Thai Bearish. I think the discontinuing of the IPO probably hurt them. In terms of what did well for last month in April, the stocks that did well, you can see is all the pandemic related stocks. I mean, like UG Health was one of them, and of course Sam Marine also, the oil and also commodities like gold and agri did well. What suffered last month in terms of stocks were the opposite of pandemic. I mean, the recovery plays like SIA, SES, Genting. So all these were the worst for last month. Again, this is just for your reference. And the table on the bottom is just as reference our performance against the STI. Okay, I think we, next slide. Okay, I think this one is just for everyone's reference. I think these are all the results coming out. In yellow is what we have covered. Of course, the big ones are the 2 banks coming out Thursday and Friday, I think. So these are the 2 big results coming out for banks. Okay, this is just for everyone's reference. I think we can end it. Sorry, we can take Q&A right now if there are any. Thank you everybody for listening.
Hello everyone. So, sorry, let me just turn on my. Yeah, hello everyone. So I think there's one question on Keppel Corp's target price. I think, and also there's one news on Keppel today. They're actually recognizing some gains from the earlier impairment of Flotel. So the total gains that they will realize is about 200 million. And it's because the carrying value of Keppel's investment in Flotel actually will increase from 96 million from December 31st, 2020 to 284 million. But we don't see a very big impact from this at this moment. We will not be making any adjustments on this because they did do a very big impairment for Keppel last year. So for our target price for Keppel, we value them based on their 4 main business segments and also the Sino-Singapore Tianjin Eco-City project. So the first business segment is their offshore and marine business. That we value at 0.6 times of the book value for the O&M segment, and so we use 0.6 times because that's in line with the rest of the offshore and marine plays in the Singapore market. Then for their property development business, we valued it at 40% discount to their total RNAV, which is also a bit in line and also a bit steeper also with the way property plays are valued. Their infrastructure business and the investments business is also valued at 12 times FY21 earnings. And then we valued the Sino-Singapore Tianjin Eco-City project at 1.5 times of their book value. Then we applied a 10% holding code discount because it's a conglomerate to get a target price of $6.12. So this $6.12 is actually about 1 times of their FY21 book value, which is the 10-year historical average of what Capital is trading at. So very much in line. So at where Capital is now, they're trading about 0.7 times book value, which is low by historical standards. So I hope I answered your question. Let me know if I didn't. Yeah, thank you. I think there's one more question on DBS. I'll probably just stick it. Let's read the question on DBS first. A question on DBS Gordon Growth model valuation. Google that the formula for sustainable growth rate is G equals to ROE times 1 minus payout ratio. The growth rate used is 2%. ROE is 10.4% and payout ratio is 50% in the valuation. Please explain how come the inputs to the valuation model do not follow the formula. Thank you. Yeah, thanks for the question. You are right. The formula for sustainable growth rate is G equals to ROE times 1 minus payout ratio. That's correct. The inputs used, if you actually do a very simple calculation. If we use the same formula to get your sustainable growth rate, the 10.4% times 50% essentially, that will give you a sustainable growth rate of about 5%, 5.2%. This is obviously very high. So if we use the sustainable this terminal growth rate, because yours is sustainable growth rate, but if we use your 5.4% as 5.2% rather as the terminal growth rate, then what happens is that this will inflate the terminal value of DBS Group under the Gordon Growth valuation model, and so your target price will also surge up. I don't have the number now. I mean, if you want me to calculate the number, I can for you, but that will probably push DBS to the share price for DBS to above 40%. So for that reason, we don't use this sustainable growth rate as an input. What we then do is we look at it from an industry point of view. We take the long-term growth rate of Singapore's GDP, which is about 2%, and then we just imply that, because the underlying assumption is that the long-term growth rate for DBS Bank should follow the long-term economic growth rate of the country in which it operates in, which is Singapore. So in this case, we use 2%, which we think is reasonable. It's a bit long explanation, but let me know if I answer your question. If I didn't, then just let me know. I will explain in more detail. Yep. So that's all for me. Thank you.
Hi. I have a question here on Hong Kong Land. Unfortunately, sorry to disappoint the 7 people who have upvoted this question. I do not really look very closely at Hong Kong Land, so I can't comment on Hong Kong Land. Yeah, I'm so sorry. One more question here for target price for CapitaLand. Our target price. Wait, let me get back to this question again. Yeah.
Okay, hello everyone. Maybe while Natalie looks for the target price, I will take the question on Fortress Minerals first. So this question came quite early. Let me read out the question first. So, hi Vivian, is Fortress Minerals still a buy recommendation since the share price has almost reached your TP of 64 cents? Yeah, so I think as of 5 minutes ago, the share price was 58 cents and the target price is 64 cents. So it's still around, I think, a low buy somewhere there. But anyway, this surge in share price for the mining stock, and also I think for their closest competitor, it has been surging. It's mainly due to the surge in iron ore prices. So I think as we all know through the news, even though China has announced that they are trying to cut the steel production, but it is not very fruitful yet. So that's mainly the reason that the iron ore prices has continued to rise. And also what we have been hearing from the ground is that even though China is looking to cut their steel production, this is mainly due to the concern due to environmental concerns. So they are also shifting the demand away from steel production by themselves to maybe say Malaysia or Australia, other countries outside. So they are importing the steel instead of importing the iron ore to produce the steel themselves. So we don't see they don't see that the demand for iron ore is going to decrease, but more distributed around the different countries in the world. So if we talk about like US stimulation and increase in construction activities, we don't think that it will go down so substantially that the iron ore prices would decline. Yeah. So that's all for Fortress Minerals. And there's a question in the chat box with regards, I think, to FSL, First Ship Lease Trust, that the current price is much higher than the TP. Is it correct? Yes, that's true. The TP is at 3 cents and the current price is 8.1 cents. But the accumulated recommendation is due to the fact that for the recommendation, we also consider the projected distributions. So for the distribution, we are projecting 6.3 Singapore cents for FY21E. That's why it's a total return of around 15%, which is the reason for the accumulated recommendation. Yeah. So thank you for the questions, and that's all for me so far. Yeah.
Okay, sorry, back to the question on CapitaLand's target price. Our target price is actually $4.38. Yeah. So of course, I'll just talk briefly. It's based on probability weighted RNAV. So of course, we assign probabilities for under the demerger situation, and if the demerger does not happen, so we are assuming an 80% probability for the scenario where the demerger does happen. Yeah. So a large portion of this $4.38 target price is attributed to the scenario where the demerger happens. Yeah. Okay. Okay, I'll take another question. With the rising local community COVID-19 cases and the potential for a circuit breaker if the situation worsens, what is the potential pullback level for the retail, industrial, and hospitality REITs? So I think if we look at how the share prices traded just last year, we saw almost a 40% to 50% initial decline when the circuit breaker kicked in. Of course, this is a very extreme situation, and I think that the government has no intention of going back to the circuit breaker unless the situation is really that dire. And in terms of how the earnings fare in such a scenario, for the retail sector, of course, we know that there was when a lot of the trade categories could not trade, the non-essential trade categories, that would mean that there will be a lot of rental rebates that have to be given to the tenants. So the rental rebates, of course, was almost anywhere between 2 months to 4 months given for the retail tenants. And based on what the situation was last year, we actually saw earnings fall by almost 15%, and the DPU fell by almost 33% for retail REITs. Okay, for industrial, I think the impact was more minimal. Some rental rebates, of course, also given. I think for the retail, for the industrial and the office sectors, it's the sector that generally the tenants were still able to operate, because for industrial, a lot of them were under essential services, and for the office tenants, I think they were still able to operate from remotely, and they still remain current on their rents. Yeah, so I think for the industrial and the office subsector, anywhere between 10% to 15% decline in NPIs, and for the retail sector was the most badly hit. Of course, most of the, excluding Far East Hospitality, which has all their leases on master lease, the rest of the REITs have some element of, you know, revenue that was linked directly to the revenue of the assets. So that one, of course, they were more impacted. Anywhere between a 60% decline, 50 to 60% decline in their DPUs. So I mean, right now, if you were to go back into you know, such a dire situation, for example, the hospitality sector, when the COVID circuit breaker first came in, I think the government block booked some of the hotel assets for quarantine or stay home notice business, and back then it was at a much higher room rate, meaning that they actually paid more for the contracts, and of course, as time passed, this contracted rate actually fell. So we are currently at the lowest contract rate that we are seeing for the government block booking, and we think that will be it will not fall further. Yeah, so of course, if you were to compare a lower room rate looking forward versus where they were last year, then I think the hospitality sector will be more impacted. That is for Singapore. But I think for other countries where they also have assets that are under block booking by the government, or you know, for the essential healthcare workers, the room rates there are slightly higher. We know that, you know, in some countries like Australia, New Zealand, these properties were actually performing better than when there was no circuit breaker or no lockdowns or no COVID. Yeah. Okay. So in general, I think retail might be hit anyway. If you're looking at another 2 months kind of circuit breaker, then that will be about 30 odd percent decline, or maybe even slightly more, because as we know, a lot of the leases that have been renewed or renegotiated are now on a lower rent. Yeah. Okay, I think that's all for me. Paul, I'm not sure if you would like to take this question. Strategy and stock picks to focus on under the potential Singapore resurgence.
Okay, I'll just take on this question, then we can move on to the TA. I think we got like lots of TA for Viren. Okay, the question is strategy and stock picks to focus on under the potential Singapore COVID resurgence scenario. If you're looking at purely local resurgence, hopefully not, keep our fingers crossed, then the one name for me will be Q&M. I think they will get two cuts. I wouldn't say benefit, but two revenue streams. Firstly, of course, dental. When under the lockdown scenario, actually, when everyone borders lockdown. I mean, not referring to local lockdowns. Actually, because everyone is inside Singapore, so actually they managed to get more visitations, and also because the dentists themselves can't travel, their capacity is actually even higher. So they benefit from that, number one. And then number two is, of course, their PCR tests. This will only make PCR testing even more important, as we can because of the elevated cases. We did get a lot of questions on breathalyzer PCR before. And breathalyzer, the sensitivity is about 95%. Whereas PCR swab is about 99, roughly around 99%. So although you may not see much on paper, but this is important. I think if you have a slippage of 4%, you can imagine if you've got like 1 million people go through, then there's like 40,000 people that's not detected. So, and as you know, our authorities are very strict and always very conservative. So we think that breathalyzers are important, but it may not be able to substitute totally the swab. I think swab is still important because of the 99%. I don't think they want to take any chances for that few percentage points. And if the volume is high, you can imagine even one case can be so problematic. You can slip to a couple of thousand. You can see on paper statistically, I mean, how challenging that would be. So for me, Q&M will be one beneficiary. Of course, on the more international front will be, of course, the rubber maker, the glove makers, UG and Riverstone. Yeah, and that would be and of course, the other one on gowns and so forth. That would be on the international scale. Yeah, I hope that is helpful. Thanks.
Okay, so wait, then hang on. So yeah. Okay, so before I start, could all of you see can you all see my screen or SMIC for now? Yeah, so I've really prepared a chart. So if you can type something on the Q&A because I think wait, let me
can't see.
oh, can't see or can see?
Cannot
okay,
see.
wait. Okay, so we share. So
yeah, okay.
Okay, so let me share again. Okay, so I will start with the SMIC. So then, yep. Okay, so pardon my messy here. Okay, so SMIC, I think someone asked, review the questions. I honestly, I don't feel good. First of all, I think price already has trending below the 50-day moving average. Is within the tight range of between 200 and 50-day moving average, means that prices are slowing down and consolidating. Preferably, I think price is going to break the support at $23.05. And then next support will be either $20 or between $18.15 to $20. That will be a rebound zone. And if I may move forward, I don't think the rebound will be that strong compared. So it will be like a slight technical corrective rebound, and then therefore after that will be gone. All right, and then I think SMIC will range quite some time going forward. All right. So next one will be BYD. BYD technically downtrend. I can see that it has already crossed below the 50-day moving average. So short-term wise, I'm looking at a downtrend. Beside that, I can see that the bearish flag has already been confirmed after price breaks below. So today, let's say today, it actually closed below the 200-day moving average already. So you can look at that. This is a larger head and shoulder. So BYD technically is going on for a very long bearish downtrend for now. Okay. Okay, so venture, yeah, okay, venture. I did issue a report that there was a buy after, and it kind of like rebounded and breaks above $20.64 or 54 cents. I can't remember, but the evening star over here actually pushes price below. So today it actually has closed below the 50. It actually has breached the 50-day moving average. You look at that, I think volume wise, this is more of like a indication that there is no much buying pressure over here. So support wise, I think 1906 to 1938 will be the next support that we're looking at. However, I think long-term support, even though it rebounded over here, I think it might face another tough resistance at $21 and then fall back to $17.22 to $17.44 before a rebound. But I foresee that in near term, I mean in mid-term, sorry about that, prices is going to invalidate the resistance zone that I have written out in my report in Stocks BNB. So yeah, hence I will be looking out for any hence you can look out for any bullish reversal signal over here before you actually a bullish reversal signal, and then looking out to break this level. If not, if this level is being resisted with tough bearish candle, then I would suggest waiting over here at 1722 to 1744. All right. Okay, so I have another question on AEM. AEM, right? First of all, I think price is going to range downwards, and then that like what I shared last webinar, I think last week. I think based on the momentum here, I think we'll be looking at a correction to the lower bound at $3.62 to $3.72. All right, the pennant is likely to be invalidated, and then hence I'll be looking at a correction down the support at 362 to 372 before rebound. Okay. All right, UMS actually hit my first target price, but unfortunately, I think it failed to hit 1.55 of my second target. So price actually has a this like a evening star look-alike, and then price gap down with a strong bearish candle back below the resistance and support. So if I would to look at it, I think the support between 1.28 to 1.30 offers a much better support going forward. All right. So that's for UMS. Sheng Siong ranging. I think long-term wise, it can hit $1.71, which is the upper band of the support, upper band of the resistance of the neckline. However, I think that price right is going the slowing down of the momentum is likely to test like lower of at 1.32 to 1.38 support zone before a rebound back to $1.71. Reason being, I think the head and this is the head and shoulder one target level zone. And then second thing, I think prices has already formed a death cross over here. So unless price actually breaks above this immediate resistance of 1.57, we might have hope to reach 1.71. But judging that from today's momentum is highly unlikely for now. All right. Okay, so the next one is Mapletree North Asia Commercial Trust. This one is much more a corrective upside really. So anytime right now, if I'm going to plot it out, so it will shows like a wedge-like pattern. So hence this stack consolidation, you can see that the upside is being kept with a strong correction down, a lower low. And hence I think that any upside will not pass $1.15. So hence I think that prices after reaching maximum at 1.15, it might have a correction down to let me draw the plot. So it will be this, and then it will come back to a support at around $1.02 before we decide on anything. Okay. So for UG Healthcare, it's performed much better than the better than Top Glove. Although despite Top Glove, I think I still maintain a slightly little corrective upside before it come down for a rank correction. UG Healthcare, right? First of all, I think the support at 0.645 offers a very good price for rebound. All right, long-term target price, I'm looking for a gap zone, preferably the lower gap at 0.865. All right, going forward. All right. So next one will be Top Glove. So Top Glove has panned out as expected, but it didn't reach a high of like $2.06 or between $2 and $2.06. But I eyeing this one to be a support. This support term resistance at 174 to 180 will be the next targeted rebound to $2.20 thereafter. All right. Okay, so Comfort Delgro, sadly to say, I think it missed by 1 cent to hit my first target price at 1.85. The head and shoulder has already been formed. So target, I think, let's see this resistance and support will be supported by the end of the day. If not, I'm looking for the next support at 1.62. To 1.60. Okay. I think today there's much more of a sell down today. So I don't know what caused it, but I think SDI is a very good example that I will show later. So for Capricorn, the support zone is approaching. So likely, based on the momentum, if it's maintaining the momentum as of today after lunch, I think this support zone will likely be broken, and then we will be seeing a new support zone at this support level between 463 to 474 before it rebound to above beyond $6. Long-term wise, $6 target to between $6 to $6.10 will be my long-term target for now. All right. So next one will be STI. STI, I think based on weekly chart, those who have attended our webinar on the second quarter Q2 2021, you can see you realize that I first of all I recommend Naurofilm. So later I'll go through what the technicals like. And then secondly, I think STI I foresee a downturn. So after a bout of a correction, consolidation, I think today weekly chart it shows a very strong bearish signal. But however, I think we do not confirm the bearish signal yet based on this the daily chart. First of all, I think the golden cross is still valid. Prices is still trending within the immediate uptrend. Okay, and then this neckline immediate support this 3141.70. So if you look at this, this may be you can consider a triple top. So once it breaks this, and then we'll be looking at the next support zone at 3014 to 3059. So I think if you're going to look at the Fibonacci target levels of the triple top, you can look at this is actually the second target, so 1-to-1 of it. So prices may actually have a false breakout below and go to 2980 before a rebound. So take note of the level at 3059, 3014, and then 2980. So these are the levels that we have been looking at to strike a rebound. All right. So next one will be I think Naurofilm. I think a price has already fails to keep my first target at $5.58. Okay, then price subsequently corrected down. So it means that this target resistance zone 1 remains a strong resistance. But however, I think support zone 2 remain at 459 to 470 remains a very strong target for rebound. So I will urge everybody to look at 459 to 470 for rebound. So for that, I think I end off my technical sharing. I think we still have like 5 more minutes. So hence, I would like to I'll pass my time to Paul and to my other colleagues to see if there's any more question to be answered. All right, thank you. Paul and DBS, Terence.
Okay. Yeah, thanks. I saw there was a few questions on Wilmar. So I just posted the link there. So one of the reasons of the weakness, again, I don't really follow Wilmar that well. It's quite a complicated company, but it's because, okay, the question is Wilmar, there's some weakness in Wilmar. What's the reason? One of the reasons is that the Chinese is switching. As you know, one of Wilmar's business is soybean crushing for the oil and then the feed mill to feed swine or pigs. So what has happened is that the Chinese, you can just click on the link that's under the chat. You can see that the Chinese are switching some of their feed meal from soy and corn to wheat. So as a result, near term, I think Wilmar will be affected in their crushing margins. I can't remember how much of it comes from crushing, but so the crushing business will be affected because of this switch in the near term. But no, longer term, Wilmar's strength is not just this. I think they got a very strong consumer product division. So I think that's why they've been kind of weak the last few days or maybe the last few weeks. Okay, I hope that helps. I mean, we don't really cover, but you can just click on the link in the chat, then you can see what's the reason. In terms of I think, okay, we answered this one, the strategy and picks. There was another question. Buffett talked extensively about inflation, which are the inflation hedges and inflation victims in Singapore. Not very easy to answer because everything depends on supply response. But the one that has benefited will be consumer names. I think we all know food inflation has been around for so long, even the supermarkets. But you notice that a lot of these companies have managed to raise prices, and even though food inflation has been around for years, I think we can compare food prices now and last year. So I think we can notice that they've managed to maintain margins or even expand. So consumer, even supermarkets have been able to contain any, and they're used to increase in inflation. The inflation victims, I guess, should be some of the utilities. I'm presuming. I'm just thinking top of my head, so I can't really think of the rest. Is because most companies have been able to raise prices, even healthcare. So so the victims and also commodities will also benefit. The victims should be on the utilities because their pricing is all fixed. And if the cost rise and if interest rate increase, then they will be the worst. Of course, I mean, you can also argue possibly even the REITs, because if inflation rise means interest rate will increase, then they would be affected too. Again, this is very broadly, I mean, so don't quote me on this. This is just very broad, just a broad direction of who will be the inflation hedge and who will be the inflation victims. It's not so simple because there's a lot of other factors in it. So even though if commodity may do well, but what if there's a supply response, then any gain would be affected as well. So just very broadly, again, just trying to help for someone who has that question. Okay, that one can share the perspective why Wilmar dived. I think again, one of the reasons is this thing, the impact on soybean crush. I hope that helps. This one I'll just take the last one because I think Viren has the US. If COVID does get worse in Singapore, which are the stocks under your coverage will you adjust EPF estimates the most or even consider changing ratings? We cannot give forward any forward indication of rating changes, but if worst case, I mean, obviously this is not the likelihood, but if you go swing back into a circuit breaker scenario, then the worst hit will be, of course, the malls, the retail, the transport, comfort, everything will be affected. So these will be the ones that will be the epicenter. Genting, So if you go back into a circuit breaker scenario, obviously it won't, but it's just a way for us to kind of understand the impact. Then it will be all these like SIA, ComfortDelGro will be also affected, and all the REITs are also those with the exposure in Singapore. So that's why I think overseas REITs like Manulife is one of our preferred pick because you can see that the pandemic is improving over in the US. Yeah. Okay. I hope that helps. I know there are a few more questions, and sorry, in view of time, we can't really answer everything. But if you want, you can just post it in our Stocks B&B website under under the community page, and we can actually help you on that. So I think I need to end it off because Viren has a 1 p.m. And again, if you want to have, feel free to register for our LISCO webinars. It's all free. Anyone can register, and just go to our Poems website. And on behalf of Research and Poems and Phillip Securities, thank you everybody for taking the time, and I hope everybody stays safe. And I hope to see you next week. And again, I know we always get this question. There is a recording of this in YouTube if you want to play back. Yeah. Thank you everybody, and hope to see you again next week. Yeah. Thank you. Bye bye.